In this presentation, we will create and analyze the effect of an invoice within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. We are going to create another invoice. Remember the objective of the invoice as we select the item up top or in our customer area. Focusing on the invoice, remember the objective of the invoice. The invoice means that we provided goods or services and now we're billing for those goods and services. We don't expect payment at the point of this bill. So when we send out the invoice, the bill, we're not getting paid. If we were sitting at a cash register and we're getting paid for a guitar, for example, that we're selling at this point in time, we would use a sales receipt as opposed to sending an invoice that we are going to supposedly most likely ship to the customer and expect payment in the future. So that's what we have here. We're going to select the invoice. The invoice, mainly when you think about it, when you see invoice, the first account you should think of is really accounts receivable. This shows that people owe us money. We're invoicing for people to give us money in the future. This customer we're going to put in here is going to be Jones Guitars. So we already have Jones Guitars down here. If you type it in here, it'll autofill, which is nice. So we will do that. No email, but we could have the email and send it by email, and that is also nice. Note that you could set up payment options for more of a direct payment through the invoicing process. We then have the billing. We've got the terms, 30 days. We're going to say the date of the invoice is going to be the 12th. I'm hitting the plus arrow or the plus on the keyboard to bring it up to the 12th. The due date will then be 30 days later, as is the terms indicated. If we have any shipping information, we can put the shipping information down below. We won't have any in this particular invoice. Then we're going to select the product or service that's already been set up for us. So all we have to do is pick it. So we'll select this and we'll say, it's a Gibson USA. We can imagine this. We can imagine that we're sold the Gibson USA. Easy for us then to determine the Gibson USA and ship it possibly with the bill with the guitar, the invoice with the guitar possibly. Here we then have the quantity 1, the rate 380. This already being in the process. We don't have to type that in there because it's in when we made the item. So it's included in the item. Tax is checked off because we do have sales tax on it. It's not calculated down here until we click down here. I'm going to click down here and it should populate the sales tax for us. Remember that in our example problem, this sales tax is using New York sales tax. We're just going to use a flat 5% as a generic sales tax to get the idea of sales tax and not go to a region. Therefore, we're going to select the sales tax and we will then adjust it by using the override feature. We will override it and make it 5% and then confirm the override. And it wants a reason because we want it. And then we'll say confirm the override and then close. So now we have the 19, which of course is going to be the 380 times the 5%. Sales tax is pretty much a flat tax. Just note that it's going to, whatever the sales price is, whatever the rate is, you just multiply them out. Typically that'll be the sales or usage tax. So it's pretty easy to calculate for that reason. So this is going to be our invoice then. Note what's going to happen, and it's really important. Every time we make a form, if you really want to understand what's going on in QuickBooks, then you want to think of what's the transaction that's going to happen. Everything except the purchase order that we've entered will have some type of financial transaction, at least 2 accounts being effective, some kind of balancing effect on the financial statements. So the invoice, once again, invoice means accounts receivable. You can think of this as tied to, most closely with, accounts receivable. Invoice means accounts receivable is going up. The other side of that will be sales, revenue, income, whatever we want to call it. We put it into a sales account because we're selling inventory, common name, if we're selling items, tangible items, as opposed to services when we might call it fees earned or something like that. Still just revenue, income type of account. The total accounts receivable will go up by the total amount, 399. That being what we charged, plus the sales tax that we had to charge or include on it due to whatever laws and regulations are there. But the sales side will only go up by the 380, our revenue income statement account. because that's all we earned for us, because we don't get to keep the other 19. The difference of the 19 then is going to increase a payable account because we owe it to somebody, sales tax payable. So that'll increase a liability type of account. Then the thing that's really kind of unusual is that we have another number that's not going to be on this invoice that represents the inventory going down because we sold inventory, a guitar, cost of goods sold. And so this invoice will drive that, will drive the decrease of inventory, even though the amount of the decrease is not on the form, because this is a form we provide to the customer and we don't want to provide it to the customer, that information. And then the other side is going to be cost of goods sold. So notice cost of goods sold is an expense account, bringing up the expense, bringing down net income. 5 accounts are going to be affected as we enter this invoice. Complicated document, although easy to input if we have this item set up well. And we do need to understand it, however, in order to see what's going to happen on the financial statements and be able to judge those reactions and that information well. So we're going to go down here now, and let's go ahead and print this one. We're going to print this, selecting the print button. We want to print or preview, so we'll print or preview. And here we have the preview screen. We'll go up top. I'm going to print it. We're going to print it to that cute PDF printer again. We'll go to the printing. We're going to put this on the desktop. So we'll put this on the desktop. We're going to scroll down to the Get Great Guitars file. Get Great Guitars. We're in section 7. This one probably should be renamed to purchase.po, not OP, but we'll keep it there for now. We're going to then change the name of this. The item that we're going to have is going to be an invoice. So now we're going to say that this is an invoice. And this is going to be an invoice to Jones Guitars. We may want that, and then put the date that we'll have here, and that's going to be 01.12.19, and save. So we can save that. I'm going to close this back out, and then of course we can save and close it, or we can have a save and a new if we wanted to create another. We now are going to go to the save and close. So let's go ahead and save and close. Now let's think about what happens to the financial statements. So if we go to the financial statements, to the reports, on the left side are major 2 reports being the financial statement, that's the balance sheet and the income statement, or profit and loss as called in QuickBooks. We'll choose the balance sheet first, selecting the balance sheet, scrolling up, changing that date from 01/01/19 to 12/31/19. That's January 1st to December 31st, 2019. Then we will run that report. So here we have it. Here is our report on the balance sheet. Remember, accounts receivable, that's the main account that we think of with the invoice. It's going to go up. If we select the accounts receivable, we see that there it is, Jones Guitars. There's the invoice that we have created. If we select that item, we see that it's going up for accounts receivable by the entire amount, $399. That's what we expect to receive. So we're going to have that in accounts receivable because we expect a check in the mail, $399. From our customer. So we're going to go back to the reports. The other side from that item, the other side of accounts receivable, if you think about it in a balancing fashion, is on the income statement. So to get to the income statement, to be able to bounce back and forth, I'm going to right click on this tab and duplicate it. And then this one is going to be another tab that we can work with. Since it's called balance sheet, once we duplicate, I'm going to pull this tab to the right and call it, this is where we're going to look for our income statement or profit and loss. So we're going to go to the reports down below. We're going to go to the profit and loss now. And then up top, we're going to change that date once again from 01/01/19 to 12/31/19. That's January 1st to December 31st, 2019. Run that report. And then we have the sales item up top. So sales, that's revenue, that's income, that's sales. So we're going to select the sales. And then within sales, we see our sales, and the one we just sold was to Jones, the Gibson USA, the 380. There's the 380. Note if we select the 380, on the invoice, that's not the total amount we expect to get. That's just the sales portion. So we only have the sales portion there. And that's because we don't get to keep the 19. Well, what do we do with the 19? We're not in balance now. What do we do about the 19? Because revenue went up, or accounts receivable went up by this, sales went up by that, we're off by 19. So what about the other side? Well, if we close this back out, the other side, I'm going to go back up and go back to the report summary. So here's our profit and loss. The other side's on the balance sheet. So we'll go back to the balance sheet, which is now in the other tab, or you could run the report again if you would like. So we'll go back to the balance sheet. And then we're going to say it's a liability. It's something we owe. So here's the accounts payable, liability. That's not the one we want, though. We want down here, New York Department of Taxation. That's what we want. We could just call it tax payable. Sales tax payable would probably be more appropriate, but QuickBooks wants to give us that vendor name, who we're going to pay New York in this case. It will differ, of course, if we're in a different location. So QuickBooks will tell us who we're going to pay there. This is who we owe, so we know. So we're going to then select that $39.50, and then we're looking for the Jones guitar. So if we select that, then we'll see the sales tax down below, which is the $19. $19, closing that back out, $19 consisting of this $8.56 plus the other one for Jones, which is plus the $10.44. There's the $19. So that kind of balances out. Now we've balanced out. However, that's not the end of it. We also have the other side, which is related to the inventory. So if we go back to the report, we know we sold inventory. We sold our guitars. So the inventory is going to have to go down. Here's the inventory. If we select the inventory account, we'll see Jones Guitars. There's the inventory account. Notice it's for 304. That's the funny thing again. Inventory is going down, but it's going down by 304. If we look here, there's no 304 on the invoice. Why? Because we don't want to tell the customer what it went down by. That would be funny. We don't need to tell the cost, what it cost us, the guitar. But the system knows, because when we set up this product, it was there. So we set up the product and it was there. If you want to find that, you can close this back out. We won't do it here. We did it last time, but you can go to Sales, Products and Services, find this guitar we sold, and then see what the cost is. That's where that information is coming from. So then you can go back here. We can go back up top and back to our forms. The other side of that then, the other side of the inventory going down, is back on the profit and loss, back to our other tab, profit and loss. And if we scroll down to the cost of goods sold, here's where the other side will be. Selecting cost of goods sold, we've got the Jones Guitars. Selecting Jones Guitars, there, once again, is our invoice. Doesn't have that amount on it, but that amount is being driven from it by the product or service. Scrolling back up, and we're going to go or close this form back out. Next thing we want to do is just take a look at that accounts receivable report again. So if we go to the reports on the left and we say, scroll down to who owes you, we want to look at who owes you. That's us. And we're going to say, we want the accounts receivable detail. So let's look at the accounts receivable detail. And then if we scroll through that, we see the Jones guitar, and the Jones guitar is going to give us that $399. Selecting that $399 there, once again, is our invoice. There, once again, is our invoice. If we close this back out, then we also see this $21,329.50. That should match the balance sheet for accounts receivable. Remember that the invoice represents accounts receivable going up. So if we go back to the balance sheet on the second tab and scroll up to the balance sheet, that $21,329.50 will match. And it almost has to. QuickBooks basically forces it to match. In other words, QuickBooks will not allow us, under most circumstances, to post anything to accounts receivable without applying it to a customer, so that when we run a report such as this, the customer balance detail, it will line up, as it should, to the balance in the accounts receivable account. For more accounting information and accounting courses, visit our website at accountinginstruction.info.